How much income will your FERS basic annuity replace within your retirement income plan? This is a question we get all the time. In this video today, I want to go ahead and address the following questions. How to calculate your FERS basic annuity, how it works, how much that pension, that basic annuity could be worth in portfolio dollars. I think that's an interesting question. What other sources of income will you have to work alongside your annuity? And how much income are you going to need, right? So it's another big question we have to answer. And lastly, how can we put this all together to make sure your money lasts throughout your retirement? So I was talking to a client of mine recently. He's coming up on 40 years of federal service next year when he turns 62. He's excited. He's planning to go out, of course. And the back of the napkin math for him looks like this. 40 years times 1.1% multiplier, because he's going out at 62 with 20 or more years of service. And so he's going to get to 44% of his high three. Big number. I'm super happy for him. It's much deserved, very long career, and he's worked hard. Now, 40 years is a long federal career. OPM tells us that the average age of an employee retiring, a career federal employee, is 61 to 62 years old. And the average length of service for the career federal employee is 25 to 26 years. So if you work 25 years, you're going to replace somewhere between 25 to 27.5% of your pre-retirement high three salary, depending on if you're able to get that 1.1% multiplier or not. Let's just back it up for a second. We know the FERS annuity is calculated like this. Years of service times your applicable multiplier times your high three salary. And that multiplier is going to be 1% or 1.1% for most federal employees. It just depends if you make it to age 62 with 20 or more years of service. That's when you can hit the 1.1% multiplier. There are special category employees in different situations where you can go out with a different multiplier, but we're going to keep it simple. So we're talking about 1% or 1.1% of your salary times your years of service guaranteed for the rest of your life. Now, the FERS basic annuity is unique for a few reasons. First of all, this type of benefit is not common for workers in the US anymore. I find benefit plans, the pensions have kind of gone away. They put the responsibility for saving on workers. So it's a great benefit to have in your corner. Now, the FERS annuity is unique for several reasons I just mentioned. First of all, it's guaranteed by the federal government, right? That's powerful stuff. And it has an optional survivor benefit that's guaranteed for your spouse by the federal government. It also has cost of living adjustments that can kick in at age 62. The contribution rate for employees is relatively low, right? It depends. That's changed in recent years as new employees are now contributing more than some of the legacy employees, but it's still low. And lastly, a special retirement supplement may be available for employees to retire between MRA and 62. Okay, so that can be an additional, it's based on Social Security. So it's unique for those reasons. So how much could a FERS annuity be worth in portfolio dollars? This is a question we get quite a bit. People come in, they say, I don't think I can continue in my federal career anymore. What would I need to do to replace this pension? What do I need to save and invest? How much do I need to earn? I don't love this question, but I do find it interesting. And there's more than one way to look at it, more than one way to answer, of course. Now, if you were to take an investment portfolio and give that balance to a private insurance and annuity company, they'd pay you a guaranteed income stream for the rest of your life. You give up, the implication is you give up the principal balance, so you just now have that income stream for the rest of your life. That number is going to be substantially less than what you would need if you're just taking money from an investment portfolio each year as a percentage basis, okay? Let's assume we're going to go that route and we're going to create a sustainable distribution from our investment portfolio. The framework we can use for this is the 4% rule, which is a strategy, it's not really a rule, that says if you limit your distributions to 4% of the investment portfolio, the principal, you have a higher probability of not outliving your money. You're making your money last over an extended 30-year retirement period. Now, of course, how you invest your money is important here as well, but that's a topic for another discussion. So investment portfolio times 4% tells you how much income you can take from said investment portfolio. If you reverse that, you can figure out how much that income stream is worth in portfolio dollars. Okay, stay with me here. So it's easier if we look at it from an example. If we think your FERS pension is going to be worth $50,000 when you retire, what is that worth in portfolio dollars? So by reversing the 4% rule, we take $50,000 times 25, it gives us $1.25 million. That's what your FERS pension would be worth using this strategy, this framework. Okay, so it's easy to see how a pension could be worth $750,000, $1 million, $1.5 million, depending on how long you work, how high that pension gets. This framework can also be useful as we're working on putting together the rest of the retirement income puzzle. What other sources of retirement income will you have available? Now, within FERS, retirement is always about the big three. So the FERS basic annuity, Social Security, and the Thrift Savings Plan. Now, Social Security is a benefit available to most U.S. workers. It's not unique to FERS, but they do include it as part of the calculations here. Depending on your savings and investing habits, you may have other assets on the balance sheet that can help, work to provide retirement income. IRAs, Roth IRAs, taxable investment accounts, real estate investments, and other sorts of assets on the balance sheet. Okay, so we just need to consider those. Now, let's look at Social Security first, because I think Social Security is interesting. It was never intended to be the primary source of income, but it is a complementary piece, and I think it's going to be important for most employees, no matter what people say about the program. How is it calculated? Of course, we know the program is funded by payroll tax. Employees pay 6.2% of their wages up to the max of $160,200 for this year, 2023, and employers match that payment. So that's how the program is funded. Social Security tells us from SSA.gov that the max benefit for this year, if you're retiring at age 62, is $2,572. And at full retirement age, if you go out at 67, that maximum benefit would be $3,627. Okay, so without getting too far in the weeds here, let's brainstorm. All right, let's just assume you're making that maximum amount, $160,200. You retire, and now you qualify for that maximum benefit. Okay, so $2,572 coming in a month. That means you'd be replacing $30,864 each year, or 19.2% of your pre-retirement income of $160,000. If you're claiming at 67, your full retirement age, and you still have the same parameters here, the same income, you would replace $43,524. So that $36.27 a month turns into $43,000 and change, or 27% of that same pre-retirement income. All right, so pretty big delta there. Now, there are a lot of variables around Social Security, and this is only intended to be a very high-level look at how the program can play into, structuring your retirement income plan. Generally speaking, individuals with lower wages may replace more of their pre-retirement income on a percentage basis than those with higher wages. Okay, it's just how the math works out. And of course, if you're waiting until 67, if you get out to age 70, your benefits are going to continue to accrue based on delayed retirement credits. Of course, I encourage you to check your estimates. Go to SSA.gov, see what your specific work record is looking like, what your benefits are estimated to be, because this stuff varies widely, of course. But if we're just using the framework I described, we can kind of ballpark things at 20 to 25% of pre-retirement income for the sake of this conversation. But again, that's going to vary based on your record. And on to the TSP account. Okay, making significant contributions, receiving employer match, investing well are all part of the upfront work to potentially create a healthy TSP balance. However, the hard work doesn't stop there. We could argue that it's actually more difficult to make your money last within retirement than it is to grow it in the first place. More risk involved from, longevity risk, sequence of returns, etc. But we can apply the same framework we were talking about when we equated a value to your first pension, the 4% rule. So if you're curious how much income you could generate from your TSP, take your projected portfolio balance times the 4% number, and that can give you what you might have to complement Social Security and your TSP. And if you're running the numbers and you know how much income you need from this source, you can reverse it again. So if you need $40,000 to make up the difference what Social Security and your first pension are providing, you take that $40,000 times the number 25, and that gives you your portfolio value. So you need $1 million in your TSP to make up the difference there, according to the 4% rule strategy, if that's the route you want to go. It's a nice framework. Like we said, ballpark stuff here, of course. Now, there are also planning strategies around the TSP that we can use to potentially optimize, maximize what you're doing there from an investment standpoint, as well as from a tax standpoint. And when you get to trying to create the sustainable income strategy, your investment mix is going to be very important, okay? So the last question I have for you is, are you contributing enough to your thrift account to make up the difference, what you need this thing to produce on an income basis? So run the numbers and see where you're at. All right, we're gonna wrap up the last part of this with other assets. So do you have other assets on the balance sheet? The same rules are really gonna apply that apply to the TSP. Do you have a Roth IRA, traditional IRA, other retirement accounts, taxable investment accounts? You can apply the 4% rule there to see how much income those sort of assets might generate. Real estate properties are gonna have unique characteristics. Tax diversification strategies can also play here. That's just using different account types that carry different tax treatments to try to optimize, maximize your money from a tax standpoint down the road. The buckets to consider: pre-tax, after-tax, and taxable investment accounts. Okay. Last step, sum it all up, right? So take your personal income worksheet out, write down all the source of income and see where you stand. Let's move on. How much income will you need in retirement? Now, this question, people get frustrated with financial planners always asking this question because it's abstract, it's out there, it feels like guesswork, and I get it. It's emotional. There's a lot of unknowns, but it's important to take a stab at it, right? To kind of see what we might need. Ask yourself some of the following questions. How long do you plan to work? How long do you think your retirement might last? What are some of those retirement goals? Put yourself in the day-to-day. Try to create a vision of what that looks like. What are those goals? What's the spending going to look like? Some other things that you might want to think about. Do you plan to pay off your mortgage? Do you plan to have charitable contributions? Are you going to support your kids? Those sort of bigger questions on how you might spend money. So if you're looking at your current situation and you save 20% of your income and you spend the other 80, goes out with taxes and all your other expenses, that's probably pretty close to what you're going to need within retirement. So most retirement planners ballpark at between 80 to 100% of your current annual spending. So take a look at what you're spending, break it down into detailed categories, and that can give you a pretty good idea of what you may need in retirement. Now, some things are going to fall off, like some expenses change, but you're going to pick new ones up. So let's just look at an example. Let's say you make 150 grand a year. You save 20% of that. That means you're spending $120,000 a year. So that means in retirement, you're going to need to replace anywhere from $96,000, which would be 80% of the 120, or the full amount, not the full $120,000, in order to meet your goals from retirement income standpoint. Some expenses that may drop off: taxes, childcare, commuting, your savings and investing contributions, obviously. And then some expenses that may increase: travel and entertainment, healthcare, fitness and wellness, gifting, professional help. We tend to have more people in the house helping us within retirement. So spend some time with it. Expenses do vary quite a bit by person. So the question I have for you is, what is your current spending and how is that likely to change over time? All right, let's take a moment to regroup. I've thrown a tremendous amount of information at you in an article and a video that was intended to just discuss the FERS pension. All right, so here are some things to consider. Many families we work with are able to replace around 50% of their income, their pre-retirement income, from their FERS basic annuity and Social Security benefits. Now, of course, this stuff is incredibly subjective, so keep that in mind. So that means it's up to the remaining assets that you have on the balance sheet, your TSP, IRAs, other retirement accounts, taxable investment accounts, real estate investments, etc., to replace the other 30 to 50%, depending on how much you need. So you need to spend some time with that and see how much you think you might need. Is it going to be enough? What's coming in based on your personal income retirement sheet? The FERS pension may replace somewhere around 25% of a career federal employee's pre-retirement I-3. That's kind of a ballpark number there to consider. We said Social Security anywhere in that 20 to 25% range, complementing that. Okay, it depends. Each work record is significantly different. So I really think that the FERS pension's role is to work as a complementary source with Social Security to provide that core of your income and really take off. It's a tremendous benefit to have 50% of your pre-retirement income accounted for from two benefits, and then make up the difference with your investment accounts. Okay, so that's a big advantage these defined benefit plans can provide. And one of the other big benefits, this really reduces a lot of the stresses, longevity risks, sequence of returns, volatility that's inherent in the markets. So when you have these guaranteed retirement income sources from the federal government, that takes a lot of the stress off the plate. But there is work to do. So I would encourage you, do the math, see where you stand, make sure you're on track. Are you contributing enough to your other accounts to get where you want to be within retirement? I hope you found this useful. Hope you can take it and use it within your plan. If you'd like to discuss what you have going on, I would be happy to talk with you. So please reach out, send me a message, and we can go from there. Again, I'm Justin with District Financial Advisors, and I hope you'll give my channel a like, and happy planning to you.